Good afternoon, ladies and gentlemen. My name is William H. Thompson, CPA MBA, and I am the founder of RE Accounting and Tax Professionals. We help real estate investors maximize return on investment through expert tax strategies, while at the same time helping to build and sustain your legacy. Welcome to Free Information Friday, and today I'm going to be discussing home flipping and taxation. So let's begin with the definition of home flipping. So home flipping, or flipping a house as they say in the business, is really simple. Your intent is to purchase a property that needs minor or significant repairs in order to sell. So you're going to purchase the property, make the repairs, and then put it up for sale for a profit. So your original intent is to buy and sell, not buy and hold. And that's critical when it comes to taxation. So let's say, for example, you purchase a house for $350,000. You put $50,000 worth of repairs into it. Now you have a $400,000 inventoriable property. It's not treated as an investment. It's treated as inventory. So one of the key pieces here is when you incur the expenses to repair that property, it doesn't get written off in that year. It gets capitalized as part of your basis when you go to sell. So let's say you sell the property for $400,000. Your profit is going to go as active income. Now that's different than a buy and hold strategy. A buy and hold is taxed and treated much differently. So let's jump into the tax treatment of it. Number one, a house that's purchased for resale is going to be taxed at your ordinary income tax rates. And that can be as high as 37%. Pretty hefty. The second thing is that you're not going to be able to get realized capital gains from this because, as I mentioned, it's ordinary income. So even if you held the property for a day and a year, or should I say a year and a day, you're not going to be able to get long-term gain capital treatment. It's going to be taxed at your ordinary income. And the third thing that's important about home flipping is that it is active income, as I mentioned. And active income is subject to Social Security and Medicare, and the tax on that. So that is 15.3% on top of the tax that you get for your income. So as you can see, house flipping and buy and hold strategies are completely different for taxation. So it's important that you understand that. Now, how can you put off or defer or avoid some of those taxes? I'll give you 3 strategies that I advise my home flippers to do. Number one, when the time is appropriate, you're going to want to form an S corporation. And when you form an S corporation, you're going to be able to avoid some of the Social Security and Medicare tax. Now, it's got to be done correctly and effectively. Otherwise, the IRS can call it into question. For example, let's say that you make your net income on a sale of property for the year is $100,000. Now that's net income, and you're now in an S corporation. You can pay yourself what they call a reasonable salary, and that's determined by you and your CPA. And we can also help you. We can also help you do that. So once you determine your reasonable salary, you draw that. You get paid, and that reasonable salary is obviously going to have ordinary income tax as well as Social Security and Medicare tax. So let's say that you drew a salary of $60,000. There's $40,000 left of that net income. You can actually take that as a distribution. And why is that important? Because that $40,000 is not subject, repeat, not subject to the Social Security tax. So that's saving you 0.153 multiplied by 40,000, 6,000 and change, I'm not sure what it is. but it'll save you that just by creating that entity and doing it properly. Number two, you can actually set up a self-directed IRA or a solo 401k. And you can pay into it, and that can also help you reduce your taxes. And again, the reason you're able to do this is because this form of income that you have is active income. So you can contribute to a retirement plan and reduce your taxes at the same time, which is a smart play. And the third thing that I usually help my home flippers with is I advise them to take a peek into their next year, what they're thinking about for the first 3 to 6 months of the following year. And I ask them to estimate what they think they're going to need in the way of equipment to either grow their business or make it more profitable. And if the cash flow is there, I encourage them to purchase the equipment in the current year so that they can get a code section 179 deduction for the equipment, which will further reduce their income. So the whole point of this little free information Friday is to note for investors that home flipping is totally different than a buy and hold strategy for taxation. So you have to plan accordingly. Otherwise, you're going to get smacked with a huge tax bill at the end that you didn't expect. And I've worked with some real estate investors who thought that they were going to be taxed as a buy and hold strategy when in fact they were actually working on a home flip strategy. So please be very cognizant of what type of either rental income or home flipping strategy that you're going to use, because it will definitely affect the way you're taxed. So don't surprise yourself at the end. If you need somebody to work with, we work with folks all over the country doing these type of strategies, working with them to make sure they're paying the least amount of taxes possible while they're growing their business income. Now, I hope this segment of Free Information Friday was helpful to you. And remember, if you're a real estate investor who wants to maximize their return on investment through expert tax strategy, while at the same time helping to build and sustain your legacy, book a call with our firm. And remember, only you can create your empire, but we are here to help you every step of the way. Thank you, and I wish you much success on your real estate journey.